You've done everything right. You've backtested for months, you've followed your trading plan to the letter, and your technical analysis is on point. Yet here you are again, staring at another blown prop firm challenge, with that drawdown limit blinking red. So, what do? You start to blame the system. The spread was too wide. The slippage was predatory. The profit target was impossible in that time frame. You convince yourself the game is rigged. But what if the real reason you keep failing has nothing to do with the firm or the market? What if it's a habit so sneaky you don't even know it's there? A habit that whispers, just wait a little longer, even when your strategy is screaming, get out now. This isn't about a bad strategy or a rigged game. This is about a single, destructive mental habit that silently kills thousands of trading careers before they even begin hope trading. And today, we're going to drag it into the light, tear it apart, and replace it with the discipline you need to finally get funded. Before we can even talk about hope trading, we have to get to its root cause. See, most traders think they fail because of their strategy, or some random event they couldn't control. The truth is, most traders fail because they don't know themselves. The real battle isn't on the chart, it's in your head. This all comes down to a psychological concept from the 1950s called locus of control. It's a fancy term for a simple question. Do you believe you're in the driver's seat of your own life, or are you just a passenger? A trader with an internal locus of control knows their success or failure comes from their own actions and discipline. When they lose, they take full ownership. They review their process and figure out what they can do better. But a trader with an external locus of control? They believe everything is determined by outside forces. These are the traders who are always blaming the prop firm's rules, the broker for stop hunting, or just plain bad luck. This creates a victim mentality, and when you see yourself as a victim of the market, you give away all your power. You stop trying to improve because, in your mind, the problem is always out there. Sound familiar? Have you ever finished a losing trade and your first thought was, if only the market hadn't chopped me out, or, if only that slippage wasn't so bad? That's an external locus of control talking. It feels good for a second because it protects your ego. But it's a trap. It keeps you stuck in a loop, making the same mistakes over and over because you refuse to admit that the power to change doesn't lie in controlling the market, but in controlling yourself. And this mindset is the perfect breeding ground for the most dangerous habit in trading. In life, hope is a beautiful thing. In trading, it's a wrecking ball. Hope trading is when you hold on to a losing position, not because your analysis backs it up, but because you hope the market will turn around and save you. It's what happens when your plan fails and, instead of taking control and hitting exit, you give up control and pray for a miracle. It's such a sneaky habit. It doesn't feel like a mistake in the moment. It feels like patience. But it isn't patience, it's denial. It's that voice in your head that says, it's just a pullback, it'll bounce back, even as the price smashes through the one level that your entire trade depended on. This habit is powered by one of the strongest biases in psychology: loss aversion. Research has shown that the pain of a loss feels about twice as powerful as the pleasure of an equal gain. This means your brain is literally wired to do crazy things to avoid taking a loss, including holding on way too long. It's why you'll cut a winning trade short because you're scared of losing profits, but you'll let a losing trade run, hoping it comes back to break even. This is the classic recipe for disaster. Small winners and huge losers. Prop firm challenges put this on steroids because of the pressure of the drawdown limit. One single hope trade that you let run can blow your entire account, wiping out weeks of hard, disciplined work. Hope becomes the emotion that lets you ignore your own rules. It replaces your strategy with a wish. So if hope is the enemy, what's the antidote? Ruthless objectivity. It's a commitment to logic over emotion. And in trading, your objectivity is defined by one thing: your invalidation level. Your invalidation level is the exact price on the chart where your trade idea is proven flat out wrong. It's your line in the sand. If the price crosses it, the reason you got into the trade is gone, and you have to get out. End of story. The best stop loss isn't based on a random number of pips or a dollar amount, it's placed at the exact point where your analysis breaks down. Let's break that down. Imagine you go long, betting on a bounce from a key support level. Your whole trade is based on the idea that this support will hold. So, your invalidation is simple, a clean break below that support. If the price slices through it, your reason for being in the trade is officially dead. Holding on past that point isn't trading anymore, it's pure gambling. Or let's say you're shorting a pullback in a downtrend, using a 50% Fibonacci level as your entry. The logic is that sellers will step in right there and push the price back down. Your invalidation point would be a clear break above that zone, maybe above the 100% mark of the Fib tool. If that happens, the downtrend is in question, and your trade idea is invalid. A hope trader stays in, praying the trend comes back. A disciplined trader takes the small, planned loss and looks for the next opportunity. It's the same for any chart pattern. Trading a bullish head and shoulders? Your invalidation is a break below the right shoulder or neckline. Once that happens, the pattern has failed. The edge is gone. Hope traders see the price blow past their invalidation level and start doing mental gymnastics to justify staying in. They zoom out, draw a new trend line, anything to avoid admitting they were wrong. They are swapping analysis for hope. If any of this is hitting home, if you've ever held a trade long after it smashed through your key level, just hoping it would magically reverse, do me a favor and hit that like button. Seriously. It takes guts to admit it, and just recognizing the pattern is the first step to finally breaking it. Now, knowing all this is one thing. Actually applying it when your money and that funded account are on the line is a whole different ball game. The only way to beat hope trading is to systematically build an internal locus of control. You have to become the person who takes 100% ownership of every single trade. Here's the game plan. First, the pre-trade contract. Before you even think about hitting the buy or sell button, you must define your invalidation level. Draw it on the chart with a big, bold line. Write it down. This is your contract with yourself. Your stop loss goes at this level, period. No exceptions. By doing this before you enter, you're making a logical decision while you're calm, before fear and greed can hijack your brain. Second, the blame audit. For the next 30 days, every time you take a loss, open a journal and write down your first, unfiltered thought. Was it, the algos are stop hunting me? Or was it, I entered too early? If you catch yourself blaming something external, you have to consciously reframe it. The market was too volatile becomes I chose to trade during a volatile time and didn't use a wide enough stop. This simple act slowly rewires your brain to look for solutions, not excuses. Third, the emotional circuit breaker. High-stakes emotions are the fuel for hope trading. You need a circuit breaker. Set hard and fast rules that take the decision-making away from you when you're stressed. A great one is a 3 strikes, you're out rule. After 3 losses in a row, you're done for the day. Close the charts. Walk away. Another one, a max daily drawdown of 2%. You hit it, you're done. These aren't just risk management rules, they are emotional management rules designed to protect you from yourself. Fourth, the detachment ritual. Trading is a game of probabilities, not predictions. You're not a fortune teller, you're a risk manager. So before each session, create a small ritual to drill this in. Say this out loud: I control my entries, my exits, and my risk. I do not control the market. My self-worth is not tied to the outcome of this trade. This act of detachment separates your ego from your execution. It lets you accept losses as a simple cost of doing business, not a personal failure. By consistently doing these things, you stop being a passenger. You get in the driver's seat. You may have been told that prop firm challenges are hard because the rules are too tight or the market is too unpredictable. You know the truth now. For most people, the challenge isn't the firm, it's their own mind. The biggest obstacle isn't the drawdown limit, it's our own internal limit for accepting when we're wrong. Prop firms don't fail you. Blaming the market fails you. A victim mentality fails you. Hope trading fails you. But the moment you stop hoping and start executing, everything changes. The moment you shift your focus from blaming the world to taking radical ownership of your actions, you take your power back. Define your invalidation on every trade. Honor it without question. Trade your plan, not your P&L. That is how you stop being one of the 90% who wash out, and start becoming the disciplined, funded trader you were always meant to be. If this video helped you, subscribe for more content on mastering trading psychology. And down in the comments, let me know one thing you're going to do this week to take back control of your trading.